This is the Law Society of Amerca, and today, we break down one of the most comprehensive and controversial pieces of legislation in recent American history, the One Big Beautiful Tax and Spending Bill, signed into law on July 4, 2025. The bill is vast. It touches nearly every part of the U.S. economy, from individual taxes and family benefits to federal aid programs, workforce development, and even the way deficits are projected. Supporters call it a new economic blueprint for working families and business growth. Critics argue it favors corporations, slashes social safety nets, and dangerously inflates the national debt. At its core, the bill reflects a return to supply-side economics, cutting taxes, scaling back federal welfare programs, and hoping that deregulation and investment incentives will trigger job creation and prosperity. Let's begin with individual taxes. One of the headline features of the law is the expansion of the standard deduction. For single filers, the deduction increased from $13,850 to $18,000. For married couples filing jointly, it rose from $27,700 to $36,000. The bill also includes a significant enhancement to the child tax credit, raising it to $2,500 per child under 17, with full refundability for lower-income families. These changes aim to provide tax relief to middle-class households and help families cope with rising living costs. Another popular provision is the elimination of income tax on tips and overtime pay. Beginning in tax year 2026, Americans working in restaurants, retail, healthcare, and other tip-based or shift-intensive jobs will no longer owe federal income tax on those additional earnings. This is framed as a pro-worker measure, particularly targeting working-class Americans often left behind in traditional tax reforms. But while many families see a break, others will face new restrictions. The Earned Income Tax Credit, for instance, has been narrowed, now phasing out more quickly for higher-income earners. And several previously refundable credits for green home improvements and electric vehicles have been repealed entirely. Moving to corporate taxes, the bill cuts the corporate tax rate from 21% to 18%, effective January 2026. It also introduces full and immediate expensing of capital investments for the next 5 years, incentivizing companies to invest in machinery, technology, and infrastructure. Additionally, a new pass-through income deduction has been added for small business owners, covering up to 30% of qualified earnings for S-corporations, LLCs, and sole proprietors. The foreign tax regime has also been reshaped. The Global Intangible Low-Taxed Income Provision, known as GILTI, has been replaced with a new framework called Net Controlled Taxable Income, or NCTI. Under this model, U.S. multinationals will face a minimum tax of 12.5% on foreign profits above a threshold, with credits available for foreign taxes paid. The aim is to reduce incentives to offshore profits while keeping American businesses competitive. On the spending side, the law sharply curtails several federal welfare programs. Supplemental Nutrition Assistance Program benefits, known as food stamps, have been scaled back for able-bodied adults without dependents, reducing coverage from 15 months to 8 months without verified employment. Medicaid eligibility requirements have also been tightened, with new mandatory work reporting for non-disabled adults aged 19 to 55. At the same time, the bill reallocates funding toward workforce development. It expands Pell Grants to cover short-term job training and trade certificate programs, like plumbing, HVAC, and software coding. This is intended to support hands-on careers and reduce reliance on traditional 4-year degrees. Beginning July 2026, eligible students could receive up to $6,000 per year towards certified career training. One of the law's more hidden but significant changes is the repeal of many clean energy tax credits. The credits established under the Inflation Reduction Act for solar, wind, electric vehicles, and battery storage have largely been revoked. While this move reduces government spending by nearly $200 billion over 10 years, it also marks a sharp reversal in U.S. climate policy. Fossil fuel subsidies remain intact. To balance the cost of tax cuts, the bill raises the federal debt limit by $5 trillion and implements automatic deficit triggers beginning in 2027. If federal revenues fall below projections, across-the-board spending cuts on discretionary programs will automatically kick in, excluding defense and veterans affairs. This fiscal guardrail is controversial, as it may force sudden cuts to education, public health, or housing programs if economic growth stalls. The total price tag. The Congressional Budget Office estimates the bill will increase the deficit by $4.1 trillion over the next 10 years. Independent economists predict the true figure could be as high as $5.5 trillion. Proponents argue the bill will generate long-term growth that offsets the cost. Opponents say that assumption is overly optimistic, warning of inflationary pressures and future austerity. Another notable change is the introduction of a family savings credit. This replaces the previous Savers Credit and offers up to $1,200 annually in tax credits for middle-income families who contribute to retirement accounts, 529 education plans, or health savings accounts. The bill also boosts contribution limits for IRAs and 401ks by 15% for workers over 40. From a legal standpoint, the bill is unique. It was passed using budget reconciliation, meaning it avoided a Senate filibuster and required only a simple majority to pass. However, because of this procedure, many provisions are set to expire after 10 years unless renewed by future Congresses. There are also new compliance requirements. The IRS will begin piloting a free online tax filing platform in 2027. Taxpayers earning under $75,000 annually will be eligible for simplified, pre-filled tax returns based on employer and financial institution data. Supporters say it will streamline the process, critics argue it risks errors and increases government surveillance. Finally, the law makes several changes to how the government measures inflation. The Consumer Price Index will now use a chained formula, which tends to show lower inflation rates over time. This will slow the growth of Social Security cost of living adjustments and federal benefit thresholds, saving the government money, but potentially leaving retirees with smaller increases. In summary, the One Big Beautiful Tax and Spending Law is a sweeping, high-stakes bet on tax relief and economic stimulus. It provides meaningful short-term gains for working families and businesses but does so by reshaping government priorities and taking on historic levels of federal debt. Whether it leads to growth and opportunity, or future financial strain, will depend on economic trends and future elections. This is the Law Society of Amerca. Subscribe for more in-depth breakdowns of how new laws affect your rights, your wallet, and your future.